February 7th, 2026. If you hold physical silver, if you hold mining equities, if your retirement account has any exposure to precious metals, the next 48 hours represent a decision window that, based on everything that has unfolded over the past 8 days, you cannot afford to sleepwalk through. On January 30th, the White House nominated Kevin Warsh to succeed Jerome Powell as chairman of the Federal Reserve. Within 48 hours of that announcement, gold plummeted nearly 15% from a record high near $5,600 per ounce. Silver suffered its worst single-day crash since March 1980, collapsing 31.4% in a single session, dropping from $120 to below $85. As of this morning, silver is hovering around $76 per ounce, which means the metal has lost roughly 37% of its value in 8 days. That is not a correction. That is not profit-taking. That is a structural repricing of what the U.S. dollar is, what it backs, and what happens to every asset class that was built on the assumption that the Federal Reserve would continue debasing it. This is not about price predictions. This is not about chart patterns or moving averages. What we are examining today is a policy pattern that is repeated across monetary history every single time a central bank has signaled a return to hard money orthodoxy after a period of aggressive debasement. And the pattern shows that the first crash is never the last event. It is the opening act of a sequence that historically reshapes precious metals policy, ownership rights, and holder economics within 30 to 90 days of the initial shock. Here is what makes this moment different from a routine market sell-off. Throughout 2025, gold and silver rallied to record highs driven by a specific narrative. That narrative was the debasement trade, a bet that the Federal Reserve under political pressure would keep interest rates low, continue expanding its $6.6 trillion balance sheet, and effectively devalue the dollar to manage $37 trillion in federal debt exceeding 130% of GDP. Investors poured into precious metals as a hedge against what they perceived as inevitable dollar erosion. Silver surged over 150% in 12 months. Gold broke through $5,000 per ounce. The entire rally was predicated on one assumption, that the Fed would remain accommodative and that the dollar's decline was a one-way trade. Kevin Warsh's nomination shattered that assumption in a single afternoon. Warsh is not a dovish Fed chair candidate. He served as a Federal Reserve governor from 2006 to 2011, emerged as an inflation hawk even during the global financial crisis, and in November 2025 published an op-ed in the Wall Street Journal titled "The Federal Reserve's Broken Leadership," in which he argued that inflation is a choice made by central banks and signaled his intention to aggressively shrink the Fed's balance sheet. Markets interpreted the nomination as the end of easy money. The dollar surged. Precious metals collapsed. And the most crowded trade of 2025 became the most violent unwind of 2026. But here is what the headlines are missing. The crash itself is not the story. The crash is the catalyst. What matters is what comes next. Because historically, when governments pivot from debasement to dollar defense, the policy responses that follow do not stop at interest rates. They extend to capital controls, transaction reporting, taxation of precious metals holdings, and in 5 documented cases across the past century, outright confiscation or forced conversion of privately held gold and silver. That is the pattern we are tracing today. If this kind of structural policy analysis matters to you, if you want to understand how central banks actually behave after regime shifts like this, subscribe now, because what we are covering in the next 26 minutes draws on 93 years of documented policy precedent, and the implications for every person holding physical metal are significant. Before we begin, drop a comment. Do you hold physical silver right now? Did you hold through the crash or did you sell? And critically, where is your metal stored? Because as we will demonstrate, jurisdiction and custody structure could matter more than the price on your screen. Here is what we are covering. First, what the Warsh nomination actually signals about the dollar and why the language matters more than the name. Second, 4 historical precedents where central banks pivoted from debasement to hard money and what happened to precious metals holders within 90 days. Third, the common pattern that connects all 4 events. Fourth, where we sit right now on that pattern timeline as of February 7th. Fifth, the legal and policy mechanisms governments deploy after hard money pivots, and why constitutional protections matter less than you think. And sixth, the 5 strategic options available to silver holders right now before the next phase of this pattern unfolds. 26 minutes that could redefine how you think about precious metals custody. Let us go. To understand why the Warsh nomination matters, you have to understand what the precious metals market was actually pricing before January 30th. Because it was not pricing silver. It was not pricing gold. It was pricing the death of the dollar. And the Warsh nomination is the Federal Reserve's way of saying, not yet. Throughout 2025, the dollar was under siege from multiple directions simultaneously. The US dollar index declined steadily, breaking below the key 97. Zero level in January 2026 and hitting 95.5, a nearly 4-year low not seen since February 2022. Federal debt exceeded $37 trillion, pushing past 130% of GDP. The auction yield for 30-year Treasury bonds was rising as global demand for U.S. debt fell, weakening what analysts call the dollar's credit backing. BRICS nations announced plans to increase the share of internal trade settled in local currencies from 35% to 50%. ASEAN began developing a regional unified payment system designed to reduce dollar reliance by 2027. Russia and China now settle approximately 90% of bilateral trade in rubles and yuan, bypassing the dollar entirely. And according to IMF data, the dollar's share of global foreign exchange reserves had fallen to 56.92% by the third quarter of 2025, its lowest level since tracking began, down from roughly 70% in the year 2000. That is the backdrop. That is what silver at $120 per ounce was reflecting. Not industrial demand for solar panels and electronics, though that demand is real and growing. It was reflecting a market consensus that the United States government, facing $37 trillion in debt and accelerating de-dollarization, had no choice but to let the dollar weaken, and a weakening dollar meant precious metals would continue rising indefinitely. The trade was simple. The dollar goes down, silver goes up. Buy silver. Then Kevin Warsh happened. On January 30th, the White House announced Warsh as the nominee to succeed Jerome Powell, whose term ends in May 2026. To understand why this single personnel decision triggered the worst precious metals crash in 46 years, you need to understand who Warsh is and what his nomination communicates about Federal Reserve policy for the next 4 years. Warsh served as a Federal Reserve governor from 2006 to 2011. During the global financial crisis, when his colleagues were focused on preventing unemployment from spiraling, Warsh was the dissenting voice warning about inflation. He opposed the scale of the Fed's bond-buying programs. He argued publicly that quantitative easing was creating moral hazard and asset bubbles. After leaving the Fed, he became one of its most prominent critics. In November 2025, he published the op-ed in the Wall Street Journal arguing that the Fed's balance sheet had grown unsustainably and that inflation was not an accident but a policy choice. His nomination communicates 3 things to markets, and each one is devastating for the debasement trade. First, it signals that the era of accommodative monetary policy is ending. Markets had been pricing in continued rate cuts throughout 2026. The January 28th FOMC statement held rates at 3.5 to 3.75%, and 2 members, Stephen Moran and Christopher Waller, voted for a quarter-point cut. The expectation was that cuts would continue. Warsh's nomination suggests the opposite. Analysts now expect a higher-for-longer interest rate environment. Higher rates strengthen the dollar and increase the opportunity cost of holding non-yielding assets like silver. Second, it signals that the Fed's balance sheet will shrink. Warsh has been explicit about reducing the Fed's $6.6 trillion in holdings. Balance sheet reduction removes liquidity from the financial system, tightens monetary conditions, and supports the dollar's purchasing power. That is the opposite of what the debasement trade required. Third, and this is the critical point, Warsh's nomination signals that the U.S. government has chosen to defend the dollar rather than allow its continued erosion. This is a policy choice with enormous implications. Dollar defense does not stop at interest rates and balance sheet management. Historically, when governments pivot from debasement to currency defense, precious metals become a policy target because private accumulation of metals is, functionally, a bet against the currency. And governments that are actively defending their currency do not tolerate large-scale private bets against it. This is the language autopsy that matters. It is not what Warsh has said, it is what his nomination means in the context of central banking history. Every major currency defense in the past century was accompanied by policy actions that restricted private precious metals ownership, increased transaction surveillance, imposed punitive taxation, or in the most extreme cases, mandated forced surrender. Not because governments are malicious, but because currency defense requires controlling the channels through which citizens can exit the currency. And physical precious metals are the oldest, most direct exit channel in existence. The Warsh nomination is not just a personnel change. It is a regime shift. It is the Federal Reserve saying, through action rather than words, that the dollar will be defended. The question for silver holders is not whether they believe in silver's long-term fundamentals. The question is whether they understand what governments historically do to private metal holders when currency defense becomes the priority. 4 times in the past century, central banks made exactly this kind of pivot. 4 times precious metals holders paid the price. Let us examine each one. Understanding why the Warsh nomination matters for silver holders requires looking beyond January 30th and examining what happens after central banks pivot from debasement to dollar defense. Because this is not the first time a government has made this choice, and the consequences for precious metals holders follow a disturbingly consistent pattern. Precedent 1, United States 1933, the original hard money pivot. In the spring of 1933, the United States was in the 4th year of the Great Depression. Bank runs had accelerated, citizens were converting dollar deposits to gold and either hoarding it or shipping it overseas. Federal Reserve gold reserves had declined from over 4,000 tons in 1931 to approximately 3,200 tons by March 1933. The dollar was under severe pressure because the monetary system was backed by gold, and the gold was leaving the system. Franklin Roosevelt took office on March 4, 1933. Exactly 1 month later, on April 5th, he signed Executive Order 6102, prohibiting the hoarding of gold coin, gold bullion, and gold certificates within the continental United States. Citizens were required to surrender their gold to the Federal Reserve by May 1st in exchange for $20.67 per troy ounce. Violation carried fines up to $10,000, equivalent to approximately $230,000 in today's money, and imprisonment up to 10 years. Exemptions existed for jewelry, rare coins, and holdings under 5 troy ounces per person. Here's the part that most people miss. The order was followed 6 months later by the Gold Reserve Act of January 1934, which revalued gold from $20.67 to $35 per ounce. That is a 69% devaluation of the dollar against gold. Citizens who surrendered their metal at $20.67 in May watched the government revalue it to $35 by January. The wealth transfer from private holders to the U.S. Treasury was enormous. The government did not confiscate gold because it feared gold. It confiscated gold because it needed to devalue the dollar, and it could not devalue the dollar while citizens held the exit ramp. That is the pattern. Currency defense requires controlling the exits. Gold and silver are exits. When governments choose to defend or restructure their currency, exits get closed. Precedent 2, United Kingdom, 1966 to 1979. By 1966, the British pound was in crisis. The Bank of England's foreign exchange reserves had declined by 18% over 12 months. Gold was flowing out of the country as citizens and institutions converted pounds to metal. The pound was under sustained pressure in foreign exchange markets, and the government's ability to maintain its exchange rate peg was eroding. The British government's response was to amend the Exchange Control Act of 1947, prohibiting British citizens from purchasing or holding gold bullion or gold coins minted after 1837. Citizens holding gold were required to sell it to authorized dealers who delivered it to the Bank of England at the prevailing London gold price, approximately $35 per ounce. Banks were prohibited from facilitating gold transactions for private individuals. Import and export of gold required licenses that were systematically denied for personal ownership. The restrictions remained in place for 13 years until Margaret Thatcher removed exchange controls in 1979. During those 13 years, the gold price rose from $35 to over $500 per ounce. British citizens were locked out of that entire move. They could not buy. They could not hold. They could only watch from behind a regulatory wall as the metal they had been forced to surrender appreciated more than 1,300%. That is not hypothetical loss. That is documented, measurable wealth destruction imposed by government policy in the name of currency defense. Precedent 3, Swiss National Bank, January 2015. This is the modern precedent that most closely mirrors the Warsh shock, and it is the one silver holders need to study most carefully. On January 15, 2015, the Swiss National Bank without warning removed its currency floor of 1.20 Swiss francs per euro, a floor it had maintained since September 2011 and had publicly declared was non-negotiable. The SNB had told markets repeatedly that the floor would be defended at all costs. On January 14th, the floor was a permanent policy. On January 15th, it was gone. The Swiss franc appreciated 30% against the euro in minutes. Currency brokers went bankrupt. Leveraged positions were obliterated. The market moved so fast that stop-loss orders could not execute. The parallel to the Warsh nomination is direct. Throughout 2025, the market consensus was that the Federal Reserve would continue accommodative policy and allow the dollar to weaken. That was treated as permanent. On January 29th, silver hit $121.64 on that assumption. On January 30th, the Warsh nomination destroyed it. Silver lost 31.4% in a single session, its worst day since 1980. The CME immediately raised margin requirements on silver futures from 11% to 15%, triggering forced liquidations that amplified the crash. 1 week later, the CME raised margins again to 18%. The SNB precedent teaches a critical lesson. Central banks lie until the moment they act. Policy is permanent until it is not. And the gap between the old regime and the new regime is measured in hours, not months. Citizens who had positioned for continued franc weakness were destroyed. Citizens who held physical gold in Swiss vaults saw their purchasing power surge. The difference was not intelligence or analysis. It was positioning. Those on the right side of the policy shift were rewarded. Those on the wrong side were wiped out. Precedent 4. India, 2016. The modern template for precious metals intervention. On November 8, 2016, Indian Prime Minister Narendra Modi announced that 86% of India's currency in circulation, all 500 and 1,000 rupee notes, would cease to be legal tender at midnight. Citizens had 50 days to exchange old notes for new ones. The stated justification was eliminating black money and counterfeit currency. The actual effect was a forced recapitalization of the banking system and a comprehensive surveillance operation on private wealth. Simultaneously, the government expanded its gold monetization scheme and intensified tax raids on undeclared gold holdings. Income tax authorities assessed punitive rates on unexplained gold, with effective tax rates exceeding 80%, including penalties. Citizens who could not document legitimate acquisition of their gold through purchase receipts, inheritance records, or bank transfers faced confiscatory taxation. Gold premiums in India surged 20% above international prices overnight. Citizens who held physical gold outside the banking system retained purchasing power, while those whose wealth was in cash deposits lost access to their own money for weeks. But the critical lesson from India is the mechanism. Modi's government did not send soldiers to confiscate gold from households. It used the tax code. It used transaction surveillance. It used reporting requirements. It made holding undocumented precious metals economically devastating through compliance costs and penalty structures. That is the modern template. Not confiscation through force, but confiscation through regulation. Now here is the pattern that connects all 4 events. Each one was preceded by a specific sequence of signals. The sequence varies in timing, but not in composition. Signal 1, currency pressure that threatens monetary policy autonomy. Signal 2, official public commentary identifying precious metals as a policy concern. Signal 3, media coverage reframing private metals ownership as economically problematic. Signal 4, expansion of legal or regulatory frameworks governing precious metals transactions. Signal 5, physical market dislocations, premiums surging, warehouse inventories declining, paper prices diverging from physical prices. 5 signals. In every historical case, all 5 were active within 90 days of policy implementation. The final signal, physical market dislocation, was consistently the last to activate and typically appeared 15 to 45 days before government action. That brings us to the question that matters. Where do we sit right now, as of February 7th, 2026, on this signal timeline? Let us walk through each signal and assess its current status. Not opinion, observable data. Signal 1, currency devaluation pressure. Status, active. The U.S. dollar index broke below the key 97.0 level in January 2026, hitting 95.5, a nearly 4-year low not seen since February 2022. Federal debt exceeds $37 trillion, over 130% of GDP. The dollar's share of global foreign exchange reserves fell to 56.92% by the third quarter of 2025, down from approximately 70% in 2000, according to IMF data. BRICS nations announced plans to increase internal trade settled in local currencies from 35% to 50%. Russia and China now settle roughly 90% of bilateral trade in rubles and yuan. ASEAN is building a regional payment system designed to reduce dollar dependence by 2027. JP Morgan has projected a further 3% dollar decline through mid-2026. Goldman Sachs, Deutsche Bank, and UBS have all issued bearish dollar forecasts for the year. The Warsh nomination temporarily reversed the dollar's decline, with the dollar index rallying on the announcement. But the structural conditions driving dollar weakness, the debt, the de-dollarization, the reserve diversification, those have not changed. They have deepened. The Warsh nomination is an attempt to defend the dollar against these forces. And historically, active dollar defense is precisely the condition that triggers precious metals policy intervention. Signal 1 is fully active. Signal 2, official commentary identifying precious metals as a policy concern. Status, active. The January 28th FOMC statement held rates at 3.5 to 3.75%, while noting that uncertainty about the economic outlook remains elevated. 2 members voted for a cut, signaling internal division about how aggressively to defend the dollar versus supporting growth. The Warsh nomination itself is the most powerful form of official commentary. It communicates through personnel selection rather than press conferences. Kevin Warsh's November 2025 Wall Street Journal op-ed explicitly argued that inflation is a policy choice and that the Fed's balance sheet must shrink. His nomination elevates that view from opinion to incoming policy. The Kansas City Fed president's January speech noted being concerned that developments of 2025 might not be done with us quite yet, referencing higher tariffs, inflation that remains above target, and rising electricity prices. The language is careful, measured, and pointed. Senior policymakers are publicly signaling concern about financial instability and inflation persistence. That is Signal 2. Signal 2 is fully active. Signal 3, media narrative framing, status, active. Over the past 10 days alone, the media narrative around precious metals has shifted dramatically. Before January 30th, coverage was overwhelmingly bullish. Silver to $200 per ounce. Gold as a safe haven, the end of the dollar. After the Warsh nomination, the framing inverted almost overnight. CNBC reported the crash as gold and silver tanking amid increased CME margin requirements. Bloomberg ran coverage framing the rally as a speculative bubble driven by Chinese traders. The Financial Times described the precious metals market as exhibiting extreme volatility. Multiple outlets published pieces questioning whether silver had become a meme trade, with CNBC running a segment titled, "Is Silver a Meme Trade? How the Metal Became GameStop in 2026." This reframing matters. When media coverage shifts from celebrating price gains to questioning market legitimacy, it creates the political cover government's need for regulatory intervention. Nobody protests restrictions on an asset class that the media has already labeled as speculative, destabilizing, and bubble-driven. That is exactly what happened before the 1933 gold order, when major newspapers published editorials calling gold hoarding unpatriotic and economically destructive. The media prepares public opinion. The government follows. Signal 3 is fully active. Signal 4, legal and regulatory framework expansion. Status, active and accelerating. On January 30th, the same day as the Warsh nomination, CME Group raised initial margin requirements on COMEX gold futures from 6% to 8% and on silver futures from 11% to 15%. On February 2nd, they raised silver margins again to 18%. That is a 64% increase in the cost of holding a silver futures position in the space of 3 days. 2 margin hikes in 1 week is not routine risk management. It is a deliberate tightening of access to precious metals markets. Higher margins force leveraged participants out of the market, reduce speculative positioning, and compress prices. The effect is functionally identical to a tax on precious metals trading. You can still trade, but the cost of doing so has increased dramatically and suddenly. This is Signal 4, the expansion of regulatory mechanisms that increase the cost and complexity of precious metals ownership or trading. Margin hikes are the mildest version. Transaction reporting thresholds, dealer compliance requirements, and tax treatment changes are the next escalation points in the historical pattern. Signal 4 is active and accelerating. Signal 5, physical market dislocation. Status, active. This is the signal that historically appears last and triggers government action within 15 to 45 days. As of February 2026, COMEX registered silver inventory stands at approximately 103.5 million ounces, down from 167.7 million ounces in October 2025, a decline of 38% in 4 months. Total COMEX warehouse inventory has fallen 75% from 346 million ounces in 2020. Total COMEX silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces in 2025. January 2026 alone saw 49. 4 million ounces delivered, more than 4 times January 2025 levels. February delivery rates are running at 98% of open interest. That is not a functioning futures market where contracts roll forward. That is a physical allocation mechanism under stress. March is COMEX's primary delivery month. Open interest in the March silver contract represents approximately 429 million ounces notional. Registered inventory available to meet those requests is 103.5 million ounces and falling at roughly 785,000 ounces per day. Industrial silver users, whose working inventories have shrunk from 120-day supply buffers to 30 to 45 days, are pushing for physical delivery rather than rolling contracts forward. Signal 5 is fully active. Physical markets are breaking, paper and physical prices are diverging, warehouse inventories are draining, delivery demand is overwhelming available supply. In every historical precedent, this was the last signal before government action. The gap between Signal 5 activation and policy response ranged from 48 hours to 90 days. The median was 23 days. All 5 signals are now active simultaneously. That has happened 4 times before in the past century. Each time, precious metals policy changed within 90 days. The clock is running. Let us talk about what governments can actually do and why the legal protections you think you have may not protect what you think they protect. The pattern begins in 1933. The United States was 3 years into the Great Depression. Bank runs were accelerating. Citizens were converting dollar deposits to gold and either hoarding it or shipping it overseas. Federal Reserve gold reserves had declined from over 4,000 tons in 1931 to roughly 3,200 tons by March 1933. The dollar was under existential pressure, so President Franklin Roosevelt did what governments do when currency defense becomes the priority. On April 5, 1933, he signed Executive Order 6102, prohibiting private ownership of gold above 5 troy ounces. Citizens were required to surrender their holdings to the Federal Reserve at $20.67 per ounce. Violation carried fines equivalent to $230,000 in today's dollars and up to 10 years imprisonment. 6 months later, the Gold Reserve Act of 1934 revalued gold to $30 per ounce, a 69% devaluation of the dollar against gold. Citizens who surrendered at $20.67 watched the government pocket the difference. That was not a market event. That was a wealth transfer executed through policy. And the critical detail is this: the pivot from debasement to dollar defense happened in the same breath. Roosevelt devalued the dollar against gold while simultaneously prohibiting citizens from owning the asset that would have protected them from that devaluation. Fast forward to 1966. The British pound was under sustained pressure in foreign exchange markets. Gold was flowing out of Bank of England reserves as citizens and institutions converted pounds to gold. The government's response was identical in structure to Roosevelt's. Through amendments to the Exchange Control Act of 1947, British citizens were prohibited from purchasing or holding gold bullion. Holdings were required to be sold to authorized dealers who delivered the metal to the Bank of England. The restrictions remained in place for 13 years until Margaret Thatcher removed them in 1979. Again, the pattern: currency under pressure, government pivots to defense, private precious metals ownership becomes the casualty. India repeated the pattern twice. In 1968, the Gold Control Act imposed ownership limits of 14 ounces for married women, 7 for unmarried women, and 4 for men. Foreign exchange reserves had declined 23% over 2 years. The balance of payments crisis was severe enough that India approached the IMF for assistance, and the government decided that citizens accumulating gold were part of the problem. Excess holdings were required to be registered and surrendered at official prices well below international market rates. The vast majority of gold was hidden rather than surrendered. Then India did it again between 2013 and 2016 with a more sophisticated approach. Rather than outright confiscation, the government implemented a gold monetization scheme offering 2.5% annual interest for voluntary deposits, while simultaneously unleashing income tax authorities to conduct raids on gold dealers and wealthy individuals, assessing punitive rates exceeding 80% on undeclared holdings. The veneer was voluntary participation. The reality was economic coercion. The program extracted approximately 15 tons of gold from private hands in its first 2 years, far below the government's 300-ton annual target, proving that citizens will resist even the most aggressive monetization schemes when they understand what is happening. 4 events. 4 central banks under currency pressure. 4 pivots from debasement to defense. And in every single case, the same sequence. First, the currency weakens, then officials publicly acknowledge the problem, then media coverage frames private metals ownership as harmful to national economic interests, then legal frameworks expand to give the government authority over precious metals transactions, and finally, physical market dislocations signal that the government is losing control of metals flows. That 5-signal pattern preceded every confiscation event. The question is where we stand on that sequence right now. As of February 7th, 2026, the answer is uncomfortable. Signal 1. Currency devaluation pressure, active. The US dollar index broke below 97.0 in January 2026, reaching 95. 5, a 4-year low not seen since February 2022. Federal debt has exceeded $37 trillion, surpassing 130% of GDP. Global central banks net sold $48 billion in dollar reserves in January alone, pushing the dollar's reserve share to 56.92%, its lowest since tracking began. BRICS nations are building payment infrastructure outside dollar networks, while JP Morgan projects a further 3% decline through mid-2026. The currency pressure that preceded every historical confiscation event is not just present, it is more severe than any previous instance. Signal 2. Official pivot from debasement to defense. Active. This is the Warsh nomination. On January 30th, 2026, the White House nominated the most hawkish credible candidate available to lead the Federal Reserve. A former governor who publicly argued that inflation is a choice, who called for aggressive balance sheet reduction, who wrote in November 2025 that the Fed's leadership was broken. Markets interpreted this as the end of the debasement narrative. The dollar surged, precious metals collapsed. This is not commentary about precious metals. This is the policy pivot itself. The government is signaling through personnel, which is the most credible form of signaling, that dollar defense is now the priority. Signal 3. Media narrative framing, active and accelerating. In the week following the Warsh nomination, major financial publications framed the precious metals sell-off as healthy and necessary. The narrative shifted from silver as a legitimate inflation hedge to silver as a speculative bubble driven by retail mania. CNBC described the rally as fueled by speculative Chinese traders, leaving prices vulnerable to sharp reversal. Multiple outlets compared silver's January surge to the GameStop episode, labeling it a meme trade. This framing matters because it prepares public opinion to accept policy actions against holders as reasonable responses to speculation rather than infringements on property rights. Signal 4. Legal and regulatory framework expansion. Partially active. COMEX has already moved to raise margin requirements on gold and silver futures following last week's historic volatility. CME Group's margin increases function as a regulatory gateway, making it more expensive to hold futures positions and effectively discouraging physical delivery demands. The February delivery data is telling. As of early February, 18.72 million ounces were called for delivery from 19.11 million ounces of open interest, a 98% delivery rate. That is not a functioning futures market where contracts roll forward. That is a physical allocation mechanism under stress. Signal 5. Physical market dislocation, emerging and intensifying. COMEX registered silver inventory has collapsed from 346 million ounces in 2020 to approximately 103.5 million ounces as of February 5th, 2026, a 75% decline. Total COMEX silver deliveries doubled from 203 million ounces in 2024 to 474 million ounces in 2025. January 2026 alone saw 49.4 million ounces delivered, more than 4 times January 2025. March 2026 open interest currently represents 429 million ounces of notional demand against 103.5 million ounces of registered supply. Industrial buyers who once maintained 120-day material buffers are now operating on 30 to 45 days of inventory. The physical market is not dislocating, it is fracturing. 5 signals, 4 fully active, the 5th accelerating, the historical median between all 5 signals being active, and policy implementation is 23 days. We are at the beginning of that window. Now, you might be thinking, this is the United States, constitutional protections exist. The Fifth Amendment guarantees just compensation. The government cannot simply take private property. Let us examine why that assumption is more fragile than it appears. Executive Order 6102 was never overturned as unconstitutional. It was legally challenged once in United States versus Bankers Trust Company, and the courts upheld the government's authority. The legal reasoning was straightforward. The Trading with the Enemy Act of 1917, amended in 1933 to apply during peacetime emergencies, gave the president authority to regulate gold transactions. The president declared a national emergency. Therefore, the prohibition was within executive power. The compensation requirement under the Fifth Amendment was satisfied at $20.67 per ounce, even though the government revalued gold to $35 per ounce 6 months later. No court ruled that citizens had a constitutional right to own gold free from government regulation. That precedent stands today. A modern implementation would not need new legislation. The International Emergency Economic Powers Act of 1977 gives the president broad authority to regulate financial transactions during declared emergencies. Declare a financial stability emergency. Cite IEEPA authority. Issue an executive order restricting precious metals transactions above specified thresholds. Require reporting, registration, or surrender with compensation at government-determined prices. The legal architecture already exists. It does not need to be built, it needs to be activated. But outright confiscation is the least probable mechanism in 2026. What is already happening is more subtle and arguably more effective. On February 15, 2026, new reporting requirements take effect that lower the cash transaction threshold for precious metals from $10,000 to $3,000. At current silver prices around $76 per ounce, purchasing as few as 39 ounces of silver now triggers a currency transaction report filed with FinCEN, the Financial Crimes Enforcement Network, your name, your social security number, your address, what you purchased, when you purchased it, all transmitted to federal databases accessible to the IRS, FBI, and other agencies. That is not confiscation, it is surveillance infrastructure. And surveillance infrastructure is the precondition for every other mechanism. You cannot tax what you cannot see, you cannot restrict what you cannot track. February 15th is the date that private silver ownership effectively ends as a concept in the United States for any transaction above 39 ounces. The jurisdictional picture reinforces this trajectory. India's union budget, released February 1st, kept gold and silver import duties unchanged at 6%, defying market expectations for relief. More importantly, India's gold imports reached $58.9 billion in 2025, while silver imports surged 44% to $9.2 billion. The government is actively discussing stricter reporting of gold holdings and expanded self-reporting requirements in income tax returns. India remains the highest probability jurisdiction for additional restrictions in 2026, given its historical precedent and balance of payments pressure. In the European Union, the fifth Anti-Money Laundering Directive already requires precious metals transaction reporting above 10,000 euros. Proposals to lower that threshold to 1,000 euros were discussed in the European Parliament in December 2025. The regulatory direction across every major economy is identical. Not outright prohibition, not confiscation with armed agents at your door, transaction surveillance expanding to capture smaller and smaller purchases, reporting thresholds declining toward levels that capture virtually all retail transactions, tax compliance mechanisms creating economic pressure to either declare holdings or divest them. The most likely scenario is not men with guns demanding your silver. It is a reporting requirement that makes every transaction visible, combined with tax treatment that makes holding metal economically punishing. It is confiscation through compliance cost, not confiscation through force. And the infrastructure for that mechanism goes live in 8 days. So we understand the pattern, we understand where we sit on the timeline, we understand what governments can do, and which governments are most likely to do it. The only question remaining is what you do about it. There are 5 options available right now. Each has costs, each has a timeline, and each becomes more expensive or impossible after policy implementation. Option 1, jurisdictional diversification. If you hold physical silver in the United States, storing a portion outside U.S. jurisdiction reduces domestic policy risk. Switzerland and Singapore maintain strong property rights with low probability of restrictions. Allocated storage, where specific bars are assigned to your account and segregated from other clients' metal, provides stronger legal protection than unallocated arrangements. If domestic restrictions are implemented, allocated metal in foreign jurisdictions sits outside the reach of domestic enforcement. Setup takes 2 to 4 weeks. If you are considering this, February is the month to act. Option 2. Conversion to exempt categories. Every historical restriction exempted certain classes. Numismatic coins, jewelry, and small holdings were exempt in 1933. Pre-1965 U.S. coins containing 90% silver could qualify as legal tender rather than bullion under future restrictions. PCGS or NGC certified numismatic coins with collector premiums would likely fall outside any bullion-focused restriction. The cost is a 15 to 40% premium above melt value. The timeline is immediate. Option 3. Mining equity exposure. If reporting risk is elevated for physical holdings but you want silver price exposure, mining equities and streaming companies provide an alternative without physical possession risks. Historical confiscation events targeted private citizens, not corporate mining operations. The risk profile shifts from policy risk to market risk. Reallocation can happen within a single trading session. Option 4. Documentation. This is the option with zero cost and zero downside that every holder should execute immediately, regardless of what they believe about confiscation probability. Organize every purchase receipt. Photograph and catalog all holdings with serial numbers where applicable. Create a paper trail linking bank transfers to specific bullion purchases. Store documentation separately from physical holdings. In India's 2013 tax raids, citizens who could prove legitimate acquisition faced dramatically lower assessments than those with undocumented gold. Once reporting requirements are implemented, creating retroactive documentation becomes impossible. Do this today, not next week. Today, option 5, strategic partial liquidation. The most conservative response. If a potential policy exempts holdings below a certain threshold, and you currently hold well above it, reducing to below the exemption line eliminates the majority of your risk while maintaining some exposure. Dealer spreads run 6 to 10%. There are tax consequences and opportunity cost, but certainty has a value, and sometimes the most strategic position is a smaller one held with confidence rather than a larger one held with anxiety. Could this analysis be wrong? Absolutely. Pattern recognition is not prediction. But here's what is undeniable. The conditions that preceded previous government actions against precious metals holders are present right now. The legal frameworks are expanding right now. Physical markets are fracturing right now. And on February 15th, the surveillance infrastructure that makes every future restriction enforceable goes live. The question is not whether silver has value. It does. The question is whether you will retain your holdings on your terms or manage them on the government's terms. History suggests that window is measured in days, not months. Use them wisely.